Hey traders, I want to talk about liquidity today. So some people will say it is liquidity, some will say it is inducement, so whatever you call it. So I'm talking about liquidity, how to identify the liquidity at your point of interest. So normally I do trade using fair value gaps as my point of interest. So when you have fair value gaps, for example, this is a higher time frame fair value gap. Let's say 4 hours fair value gap, and then we'll move to 15 minutes for confirmation. So in 15 minutes, you'll see something like this, whatever I've drawn here. So these are bullish buyers. So we have this. When we have a price coming here, normally the first one here, we are having a break of structure here. So this is a break of structure. And then we had this level also. So this is again another break of structure. So we have that. So we have break of structure, and then we have another break of structure. Also here we are having another break of structure, but I want us to concentrate here. So in this movement from here to here, we created a fair value gap in the higher time frame. So what the price did, it came, tried to enter into that fair value gap, but it failed. Again, it pushed, sweep the liquidity up here, and then it came back, sweep the liquidity down here, and then it moved. So when you're having this fair value gap, when you look at lower time frame, we have this level here. When the price came, it tried to enter the fair value gap, but it failed. It is creating what we call liquidity. So here we have liquidity. That is liquidity. So down here, up here, in this area here, the liquidity is lying here. So what we expect the market to come to do, first you have to know if it reached the discount area or not, and that one you do using the Fibonacci. If you don't know about Fibonacci, it is a tool in a trading view, you can find it there. So it helps you to measure to know if the price have reached discount or premium level depending on the direction of the market. So here we have the price coming, it reached to 38%, so meaning it did not reach the discount, so we cannot buy when it has not reached the discount. So still it is on the premium. So you don't buy in premium, you only buy when it comes to discount. So here we had 50% here. Let me extend it. When we look at 50%, 50% is here, this line here. So when you see this one, and then we have our point of interest here, you will know that the price will come, sweep the liquidity here, enter into discount region, and then continue with the movement. So that is how you spot the liquidity. So this is the first scenario. The second scenario is this one here. Also, you might get the price moving in such a way. So we have this one, this is where we have break of structure. We had also break of structure here. So this is another break of structure. So we have this one. When we look at this one here, our point of interest is this fair value gap here. So this is a lower time frame, you will see such a structure. So when we look at this one, the price came, entered the fair value gap, and then pushed, it failed to break the structure here, and then it came back again, sweep the liquidity, and then moved. So here, this one, if it fails to break this structure, it means it is creating its own liquidity here. The first movement, the first attempt in the fair value gap. it can either come inside the enter inside the fair value gap, or try to enter the fair value gap like this one here. So this one entered into fair value gap, attempt to move, but it came back, sweep the liquidity. So this one is creating its own liquidity. There's difference between this one and this one. This one swept the liquidity before coming. This one failed to sweep liquidity before coming back. So this is where the liquidity is lying. So it will sweep the liquidity and then move. So when we use again Fibonacci, will help you. When you look at this movement, the first attempt, it did not reach 50%. So meaning we cannot buy at the premium level. So we waited for the price to come into the discount level and then pushed up. So that is how you identify liquidity at your fair value gap. Let me try and show you some of the examples. This is GBP USD 5 minutes. Not 5 but 15 minutes. This is for scalpers, but it goes along in different time frames. It's the same concept. So we have this fair value gap here. We have this fair value gap here. When you look at this fair value gap, we are using 15 minutes, so meaning we are moving to 1 minute for confirmation. When you go to 1 minute time frame, we are having this. We have this. So I want you to concentrate here and see whatever happened. So this was the movement. Here. We had this one. This is where the break of structure happened. This is the break of structure. And we also had the break of structure here. This one is small, but it a valid break of structure here. We have that one. So when we see the price moved, attempted to enter the fair value gap, but it failed. It went ahead. There's a run of liquidity up here, and then it came back. So liquidity that was formed was here. This one. So that is where the liquidity was lying. And then when you use Fibonacci, we are starting from this low up to here. The first attempt, not here, up to here. So when you look at this one, it came, this is around 38%. It did not reach 50%, and then it went ahead and then came back for the liquidity, which it swept and then come. This is where 50% is. It entered 50% and then it is pushing up. So I hope you are seeing. So what you should do, below the 50%, you have to look at another point of interest. Here we had this fair value gap here. So that is the area which the price reacted. So you can use your entry here if you don't want to confirm entry. You can use this as your entry. You just put your entry here, and then I'm using the same candlestick that form the fair value gap for the stop loss, and then we are aiming up here. You can just aim like that. So mostly this is for the scalpers. This is a very good RR, 6.8. So that is a good RR. It came, you can see it hit the TP and then continued moving up. We can also look at another one. I don't know if I can find a close one. Let me see if I can spot another one. Let me just remove these ones. But that is how you find trades. But you need a lot of patience. You don't have to just guess anything. You need a lot of not a lot of patience in the market. Let us look at this one. This one also the price came to that fair value gap. So let us move to 1 minute time frame and see what happened. So this is where it happened. So let us look at this. So when you look at the price here, this is where retracement happened. So now I have this one. And guys, you must know the bias of the market before using this lower time frame. So we have that, and then when you look at the break of structure, we are not considering this one, it is happening inside the fair value gap. So we have this is where the break of structure happened, and then we have this one here. So when you look at this one, there was no sweep of the liquidity at this point, so it has to form its own liquidity either inside or attempt to go inside. So it did it here. This is where there was a sweep of liquidity. After sweeping the liquidity, so this was the first attempt is for creating the liquidity, and then it came, swept the liquidity, and then it moved. Another thing that you had to consider, inside this area also there was a liquidity here. So this one could have been your point of interest inside that fair value gap in a lower time frame. So your entry was supposed to be here, and then target that candlestick here, or here, the one that created that, and then we just target here for the scalpers like that. So that is how you trade using fair value gaps, and also how you identify the liquidity. I'll see you in the next video.